Welcome to another episode of Vision and Voices, where we dive into the intricate and dynamic world of family offices. I am your host, Chris Mays, a partner at Armanino, one of the top 25 consulting and accounting firms. Here at Armanino, I have the privilege of leading our family office industry, helping ultra-high net worth individuals and families navigate the complexities, wealth management, tax planning, and legacy preservation. In each episode of Vision and Voices, we bring to you insights and expertise from leading professionals across various fields relevant to family offices. From legal experts and investment strategists to technology innovators and philanthropic advisors, our goal is to provide you with the knowledge and tools to manage and grow your family's wealth effectively. Today, we have a special guest, Jason Buhlinger. Jason is a partner in the consulting practice of Armanino, leading a team of specializing in providing business valuation services. These valuation services include business valuations for gift and tax purposes, stock option pricing analyses, purchase price allocations, complex security valuations, goodwill impairment analysis, and various transaction-related services. Jason and the business valuation team at Armanino have valued clients in a wide range of industries, ranging in size from early startups to multi-billion-dollar entities. Jason also has a background in forensic accounting and litigation support, having provided expert witness testimony on a wide range of cases, including business valuation, lost profits, damages, and asset tracing. Jason is a licensed CPA, accredited in business valuation, a certified fraud examiner, and a certified valuation analyst. Jason, welcome to Vision and Voices.
Thank you, Chris. It's good to be here.
So can you share with us your journey into the world of valuations and appraisals and what drew you to specialize in this niche within the accounting profession?
Yeah, absolutely. So I had an undergraduate degree in finance. When I was going to school, I never thought that I'd be at a public accounting firm, or much less a partner at a public accounting firm. Coming out of school, I thought that potentially I wanted to be a wealth advisor, and then an internship at Merrill Lynch, and realized that the account minimum of $100,000 was going to be pretty tough for me to overcome right out of school. So I started looking for positions that were much more analytically focused, and started looking at some positions in corporate finance at some publicly traded companies here in St. Louis, where I sit. And then came across a position with a small kind of regional accounting firm at the time, doing business valuation and litigation support. And so I had kind of always thought in the back of my mind I might go to law school. And I thought, well, this might kind of itch both of those, or scratch both of those itches. And so I started doing the business valuation and lit support, and I've been doing it ever since.
Right on, right on. So for those unfamiliar, could you explain what a business valuation and an appraisal entail, especially in the context of family offices and ultra high net worth individuals?
Yeah, so a lot of times, and what we'll see for family offices and high net worth individuals is there are certain tax advantages to setting up legal entities that you can put your investments in, particularly as you look to gift equities or assets from one generation to the other. And so they'll set up these legal entities, and as part of their planning, they need to have those legal entities valued, because they get discounts for lack of control and lack of marketability. So what we do is we help, because they're privately held entities, we help determine what the value of those legal entities would be worth under the IRS's direction, which is fair market value, which is the standard of value the IRS typically requires, as they look to do a lot of that planning.
So what are the most common types of assets or businesses that you value for family offices?
So we see a lot of asset holding companies. So we see real estate. Yeah. Sometimes we'll see operating entities that sit within a corporate entity that is more of an asset holding company. So let's say the family's main source of wealth was an operating company that they've had for the last 40 years. Sometimes there will be interest in that operating company still within that family, that legal entity that was set up. We see stocks, bonds, mutual funds. We see notes receivable, notes payable to other related parties or non-related parties, in addition to things like equity investments or real estate fund investments.
Right. So how does valuing a privately held business differ from publicly traded companies?
So when you have an interest in a publicly traded company, you can go out on an open exchange and you can determine readily, every day what that interest is worth. Privately held businesses are much different. The value, is much more difficult to ascertain. Oftentimes we're looking at, if it's an operating company, we're looking at an asset approach, an income approach, and a market approach to determine, what the value of that entity is, and then we're calculating discounts from there, both for lack of control, because if you have a minority interest, you don't have the ability to do whatever you want. So on a pro rata basis, it's worth less for a minority share. And then we take a discount for lack of marketability because, to my earlier point, we can't call our financial advisor and liquidate our interest, by noon, like we could Apple or, ExxonMobil for that matter.
Right. But so are they additive, right? Lack of marketability and lack of control. Can you add those two discounts together, or is there a covariance between those two that makes them not be able to stack exactly on top of one another?
Yeah, we take them sequentially. So you take the discount for lack of control first, typically, and then you take discount for lack of marketability on the amount that remains after the discount for lack of control is taken. So they're not.
Is there a degree of lack of marketability or a degree of control, or is it binary?
No, there's a degree of both. It just depends on a lot of things like the assets that are held within the business, the rights and transferability restrictions to an owner play a part into it. So there's a lot of studies, there's a lot of analysis that we have to do to really support what those discounts should be.
Right. And can you tell me a little bit? I kind of know the answer to this, but for our audience's benefit, like what role do those discounts play in, let's say, wealth management or estate planning or succession planning for wealthy families?
Yeah, so if you have a bucket of assets, you'll stick them in a legal entity typically, and then you'll gift a portion of that legal entity. And because it's a legal entity that owns these assets, that is privately held, and oftentimes a minority interest, will take a discount for lack of control and lack of marketability. And so what it does is it allows a family office to move assets outside of the taxable estate at a value per dollar less with a discount. So instead, if you've got $100 million of assets, you stick them in a legal entity, you might be able to take discounts and move them out at a value of, $60 million.
Right.
Instead of $100 million.
Right. So from a estate tax reporting, you use up less lifetime exclusion if, to the extent you can get a discount, or you pay less estate tax in to the extent you're over your lifetime exclusion.
That's correct. Yes.
Okay. So what are the critical steps to conducting? You talked a little about three different approaches, but could you go a little bit into the details of what's required for either, and actually compare and contrast an appraisal versus evaluation?
Yes. So anytime that we're going to perform an evaluation, we have two types of engagements that we can do. We can do an opinion of value, or we can do what we would call a calculation of value. A lot of times we're going to be brought in to do a calculation of value, not in the context of gift and estate tax, but really if we've got a client that wants to sell an interest in a privately held entity and they don't really know what it's worth. And so they'll hire us to come in and they'll say, look, we just want to understand at a high level what we think this is worth to start negotiations. And so we can do a market approach, we can do some high level add backs just to kind of get a rough value that they can use to start negotiations. Alternatively, if we're going to do an opinion of value, that's when we're going to consider that asset approach, income approach, and market approach. And so the process starts with, we get an engagement letter, we send a request list over, and usually what we like to see are 5 to 7 years, at least the big items, 5 to 7 years of historical tax returns and financial statements, along with any type of or set of projections that maybe exist in the ordinary course of business. And so then from there, we'll perform an asset approach where we look at the fair market value of the assets less the fair market value of the liabilities. We'll perform an income approach where we look at the present value of all of the future cash flow of the business. And then we'll perform a market approach where we look at sales of either equity in the subject company itself or in peer companies or guideline companies that we can use to determine a market approach. So a peer company sells for 5 times earnings. we got a company that's very similar, then, vis-a-vis, we can say, all right, it's probably worth 5 times earnings.
Right, right. So, okay, so beyond you need financials. What other documents and information beyond financials and these in place projections? What other documents do you typically need in order to complete the valuation?
So we ask for appraisals of other, if anybody else has done appraisals of either the business or the underlying assets. A lot of times those are helpful. A big one for us are the organizational documents, right? Because if we're going to be calculating discounts, we really want to understand what the rights and restrictions are for the equity holders in the business.
Right.
And so we ask for those buy-sell agreements, those operating agreements, the bylaws. The cap table becomes particularly important, particularly if we have complex cap tables, to really understand, okay, who owns what and what do all of the various tranches of equity look like that the business might own. So those things are important for us as well.
Yeah, right. Because not all equity is created equal. Fair. Okay. So what about market conditions? When we had the rate rip in 2022, right, when the Fed increased rates to close to 5%, now back down to about 4.5%, at least the risk-free rate. How do market conditions impact valuations and appraisals?
So it can affect us in a couple of different ways. First and foremost, in the market multiples. So anytime there's, some sort of a seismic shift in the underlying market, either through rates or, COVID's a good example where it kind of disrupted markets. We really want to make sure that if we're going to use a market approach and we're going to look at comps, that those comps also reflect that risk in the market. So, using a pre-COVID multiple with a post-COVID valuation may not be the right analysis to perform. And so we want to make sure we take that into consideration there. And then, depending on market conditions, like certain industries will get hot. Our own accounting firm industry is hot right now, right? So making sure that if we're valuing something like an accounting firm, that we're taking into consideration those market conditions to show that the increase in multiples are there, and to really understand our subject company and say, all right, we can see what's happening in the market. Do those market conditions translate into our underlying subject company? Is it healthy? Is it doing the right things to make it an attractive investment for a typical market participant?
Yeah, okay. So what are the most challenging situations you've encountered when appraising assets for family offices?
Oftentimes it's just being able to get enough granular information down to the right level to make sure that we've got all of the assets accounted for, and that we can determine the rights and restrictions of all of those individual assets. A lot of family office clients have, significant net worth, and they've got investments kind of all over the place. And so just being able to get our arms wrapped around the bucket of investments and how everything intertwines together, a lot of times is pretty important for us.
Yeah, so a lot of times we see families will have, they may have securities. Some of those may be public, private market, could be, private equity or hedge funds or venture capital funds. They might also have real estate, and then they might also have all sorts of different interests in either direct ownership in companies or derivatives. Excuse me. How do you put that all together in terms of evaluation?
Yeah, so a lot of times it's looking at that legal entity, looking at everything that's embedded inside that legal entity, and then stripping out each of those individual components and determining the fair market value of each of those individual investments. Kind of going back to the 3 approaches, whenever we have a holding company, let's say we've got a family limited partnership with a bunch of different disparate types of investments, the best way to value that is an asset approach. We take the fair market value of all those holdings. And so we have to go through and individually value each one of those holdings and roll them all the way up into the corporate entity.
So I have this billionaire real estate client, and he loves his coastal properties. And he's like, look, they're not making any more coastlines. Some of these properties I don't want. I will never sell. My kids will never sell. Their kids will never sell. These are heirloom types of properties. So how do you navigate the emotional or subjective aspects of valuing these types of family heirlooms?
You kind of have to step back and look at fair market value requires you to look at where would two parties come together in a hypothetical negotiation between a willing buyer and a willing seller. So a lot of times we kind of have to remove ourselves from what's going on, the emotional attachment, and say, all right, if we had two hypothetical willing and able buyer sellers, where would they come together in a negotiation? And so that's where those documents become critically important. It helps us kind of remove ourselves from the, a lot of the I guess the emotion behind it for a lot of the clients, and really kind of get to, all right, look, let's just look at the face of the documents and what do they say and what can and what could an investor not do with these properties.
Yeah. Okay. So basically, we don't take into account the family's heirloom aspect of it. It's just two willing market participants, whatever value they come up with.
Correct. Yes.
Yeah. Okay. You also do some expert witness work as well. So in litigation or disputes, what role do valuations play, and how do you ensure impartiality?
So a lot of times where we'll get pulled in a litigation is, let's say we've got two owners or three owners. They used to get along really well, and now all of a sudden, they need what we call business divorce. All right, we're not getting along anymore. We want to split this thing up, or one party wants to buy the other one out, and we really need to understand what it's worth. Sometimes it's heavily in the throes of litigation, and each side thinks that the value is worth something else, and they need an appraiser to come in and break the tie and really to kind of understand what the underlying value of that business entity is. And so we get pulled in to value those individual interests. As we look at it, it's important, to your point, that we come in with a clear mind and we just want to look at the facts here. There are a lot of high emotions that fly from both sides, and you really have to do your best to look at industry research, economic research, have conversations with members of management to really kind of understand, okay, what is the heart of the issue and what are the facts here versus kind of what's somebody's opinion on how things may or may not play out.
Right. So have you noticed any recent trends in the valuation needs of family offices or wealthy individuals as of late?
Yeah, we did see a very big push kind of towards the end of this year with the sunsetting or the potential sunset of the TCJA. So we saw quite a bit of going on, kind of looking to see what we think may happen over the next 12 months with the sunsetting of the lifetime exemption. We did see a lot of that, and we get pulled into a lot of complex things where hey, we've got, to your point earlier, we've got this legal entity and it's got 42 different investments, and we really need to understand what this entire legal entity is worth. And maybe we're not getting rid of all of it, but our estate planner is crafting some sort of scenario where we get rid of a portion of it, or we recapitalize it to 1% voting and 99% non-voting in order to move a bigger chunk of it outside of the estate with more discounts.
Yeah, well, we're recording this on November 18th, 2024. So we're post-election. Trump has won. And at least his public comments have been that he's going to continue the tax cuts under TCJA. So do you think it's a possibility that the current lifetime exemption for an individual is $13.6 million? Do you think that continues for now, or have you heard any scuttlebutt in terms of what the likely outcome is for the lifetime exclusion?
I have. So I was actually at a lunch this afternoon on this very topic, and what the presenter, who is a presenter that does a lot of estate planning nationwide, it's a bigger firm, and said, right now we're operating in a period of unknown, when we operate typically in the finite to help clients understand where they're going, right? Kind of the advice was that the consensus was we should get a better feel early next year when things start getting introduced. They would expect a big bill to be introduced into the House, which would provide some clarity around that. I think we could see a world where the lifetime exemption doesn't sunset, But then again, you could find another world where the lifetime exemption does sunset, but other parts of the TCJA carry on. And so it's
Fair.
just kind of
Yeah.
figuring out there is going to be some way to pay for all this stuff. And so the consensus is, some of it may carry on and some of it may not, in order to pay for some of the stuff that does carry on.
Yeah, no, that's a good point. So, because our advice earlier this year, pre-election outcome was, hey, get your planning in, because this is going to be similar to, I think it was 2016 when we didn't know what was going to happen then, and so we pushed everybody to use up the lifetime exclusion and do whatever planning they wanted to do, only to, and frankly, we're running out of capacity with estate lawyers. It's just, if everybody comes to do some estate planning in a single quarter, in fact, I think we ran up against capacity with you folks too, right? We couldn't get valuations because, clients unfortunately came in late to the game, and there just wasn't enough bodies out there in order to complete the valuation. Unfortunately, it didn't turn into anything. And so, our advice coming into this change was, hey, get your estate planning done early, take advantage of this larger lifetime exclusion than what we've seen historically, and just take those chips off the table. Now that isn't going to happen, I don't know, if people have in place planning that they were planning to get done by year end, should they continue to do it, or should they be in a wait and see aspect, from your opinion?
The consensus today, when I was on that was continue with your planning, set it up, and be ready to pull the trigger if you need to.
Fair.
Yeah. Because you still don't know what's going to end up. And to your point earlier, the biggest, I think, issue is if everybody waits until you get clarity, it might be too late in order to do the planning, because there won't be enough attorneys, estate planning, CPAs, and valuation people within the industry to satisfy that much demand in that small amount of time. So the consensus was, get everything set up, I's dotted, T's crossed, ready to be signed until you get more clarity, and then you can decide whether it's a green light or a red light.
Yeah, no, that makes a lot of sense. So how is technology changing the landscape of valuations appraisals? Are there tools or software that you rely on more heavily now than you have in the past?
Yes, we're always evaluating. I mean, with the advent of AI, we're always evaluating ways to use software to make us bigger, faster, stronger. We use a software. It's an off-the-shelf software to implement to write reports. And it doesn't write the reports, but what it does is it allows us to link between our workbook and our written report, and we can update things with the click of a button. So it just goes through and auto updates everything, right? So we're always looking at ways to make things bigger, faster, stronger. Our team has been early adopters of some of the Armanino Enterprise ChatGPT licenses, and really trying to use that to take voluminous documentation from clients, things like, buy-sell agreements and things like that, to condense it down into a much smaller version so that we can put that into our report. So trying to figure out ways to continue to add value, but not spend time in the less value-add items like reading through a 75-page report.
Yeah, no, I hear you there. I find some of the AI tools are really good for creating abstracts of trust documents. I mean, you got to verify because they are subject to hallucinations, but providing putting together flow charts for estate plans and abstracts, it's a pretty helpful tool. So, okay, well, with Trump and team in office now, I think we're going to see a resurgence of cryptocurrencies, right? Bitcoin traded through $90 per token. And I'm wondering, and potentially NFTs come back with, if Trump's able to achieve his goal of getting rid of Gary Gensler. So how do you look at those types of assets from a valuations perspective?
Very carefully. Very carefully. It depends. We get pulled into a lot of those valuations from we want to make a charitable gift. And so, we want somebody to, even though sometimes we'll have, even though this token is traded, or this coin is traded on an open exchange, we still need an appraiser to come in and write it because we need to get the form filled out with the IRS, and we need somebody to, so even in those cases, we'll really dig in, really try to understand whatever the currency is, get some background on it, look at what it's trading in, look at the volume to make sure the volume is there.
Get $1 billion worth of Doge. Like, yeah, right. The trading volume is not significant enough for me to liquidate that inside the next 30 days. So like, how would you deal with that?
Yeah, it's on a case-by-case basis. We really, each one is customized. I mean, we have to look at kind of the facts and circumstances of each one. And I mean, to that point, in that case, maybe you've got a much bigger discount for lack of marketability because I can't get rid of the thing because I own a big chunk of it, right? So I can't just dump it on the open market.
Yeah. So, I mean, that's one of the greatest tax benefits, right? If you give a low basis security or cryptocurrency or any low basis property, right? You get the full fair market value deducted, and yet you never pay tax on the capital gain, right? So it's actually, it can be accretive, right? From a truly economic benefit to giving to charity. In other words, you'll reap more in tax deduction than you're giving value away. And so how do you, like, for securities where there isn't enough volume, because even in the public markets, some of our clients, they couldn't liquidate their holdings. It's too significant of a portion of the company, for if they keep hitting it every single day, they're going to drive the price of those shares down. How do you look at a security like that and make an assessment for a significant block of those shares?
Yeah, and in those cases, we'll look at things like restricted stock studies, where we've got studies that go back when they're looking at share, blocks of restricted stock that have been sold over the years, and kind of try to peg, okay, how much of this do we think? When can you dribble this out to where it's not going to matter enough, but you do have a discount for lack of marketability on there because the block size is so significant. So we would rely on things like those restricted stock studies to help us kind of peg that discount for lack of marketability.
Yeah, but that actually, I mean, I think those studies work both ways, right? Because to the extent there's a control premium inside of that, right? That, if you just look at the control premiums, I mean, it could be anywhere from 25 to 50% control premium on public market shares for being able to, to buy that block, to buy the control block.
Right. Yeah.
But then on liquidation, it's the potentially exact opposite, right? Where you might have to, maybe not a 50% discount, but you might have to take a pretty, well, depending upon the size, it could be a 50% discount. So how do you navigate those issues? Because I can imagine they're probably pretty esoteric and situationally specific or idiosyncratic. How do you, because that could push the needle fairly significantly on a valuation.
Yeah, each one's different. So it gets pretty technically. So how do I answer without being super technical? Depends on what adjustments we make in the process of the valuation to determine if the equity value that we get is at a control level or already at a minority level. So sometimes we can, if we make control type adjustments, then we'll end up at a control level of value. And if we have a controlling interest, then we just don't take a discount for lack of control. But we may have enough of it to where we've got, a bigger discount for lack of marketability because we can't get rid of it quick enough. Other situations where, we're going to use a set of guideline public companies, and we're going to look at the multiples of those, and maybe those are already on a minority basis. And so the number that we get is on a minority basis, and we have to give it a control premium in order to get to whatever that control value is. And in that case, a lot of times what we'll do is we'll look at sales of similar types of businesses that have sold. We'll look at the control premiums that were paid, and we'll use that as a proxy for what we would think the discount or the premium would be on the subject company. So yeah, we have to be very cognizant as we move through the valuation, like what level of value we're getting, so that we take the right discount at the right times or apply the right premiums at the right times.
Right. Yeah, and then it just probably becomes if you ever get into a dispute on it with the IRS or other regulator, it's just the culmination of facts, right? I mean, can you prove out your position relative to their opposite position? And I mean, does it go down any differently than that?
Yeah, no, I mean, I think that's where, having a background in litigation support is particularly helpful too.
Yeah,
So,
fair.
I've got a little bit of a situation, a background where it's like, okay, I'm used to writing reports that I think can hopefully break down some of those complex topics and get them across in a way that I hope is easily followable and provide enough support for the opinion that we're taking versus, some sort of a kind of more of a canned approach where we kind of, someone slings something at the wall and then kind of hopes that the IRS can figure it out and then go from there.
Yeah. What should family offices or wealthy individuals consider when seeking valuation or appraisal services?
You're going to want, typically, first and foremost, you're going to want a team that's big enough and has enough expertise to be able to value all of the types of disparate holdings that you might have. So, for example, you might have real estate property. You want some, ideally you want a firm that you can handle the commercial real estate appraisal piece. If you've got some convertible warrants or something like that you own, someone that can value that, someone that can do the discount studies. And so you want kind of someone that really understands all that in one place because it's going to make it much more efficient from an overall valuation standpoint. And plus, they're going to know how those things work together versus having somebody that just does their individual piece, and then you're kind of piecing all those together to come up with the overall valuation.
Yeah. Okay. What common mistakes do families or their advisors make during the valuation process?
Well, I'll say this because I'm not a low-cost provider, but I think sometimes, going to a low-cost provider, sometimes you get a little bit of what you pay for. So you may not get as robust of an analysis as you otherwise would need or should get in order to really make sure that, if you're gifting something, that you've got, all of the IRS requirements for adequate disclosure met, and you've got a good report that backs everything up behind it.
So how can families use valuation service proactively rather than reactively, like during a sale or a dispute?
So one of the things that I think is, at least I hope is helpful with evaluation, and we talk to a lot of our clients about, this isn't necessarily in the gift and estate tax context, but if we've got an interest in a business and we want to sell it, the planning process for maximizing the sale price of a business should start 2 or 3 years ahead of the exit. We see a lot of times says, hey, I've got an LOI that I signed. Can you guys help us determine if this is a good value or not? Or, even our transaction team will, they'll say, hey, we got an LOI signed. Can you guys help us with some quality of earnings work? And it's like, oh boy, we could have done a lot if you had started 2 or 3 years ago because you're not managing the business for sale. I mean, a lot of us, it's no different than when you have a house. When you want to sell your house, you bring the agent in, the agent walks through and they tell you all the stuff that you should have fixed 6 months ago, and you haven't done it, and you got to do all that. But it's a little bit different. It's got a longer tail with a business because, when you have an appraiser come in and tell you, hey, here are the things, here are the risk areas in this business. You can't just fix them and then have somebody pay you a multiple of that. What buyers want to see is it fixed, but then they want to see a track record of success post-fix before they'll pay for it. And usually they want to see 6, 12, 18 months of success of this stuff working before they say, oh yeah, we'll go ahead and pay you a multiple of that. And so having those valuations done earlier rather than later, we can elaborate and say, here's the value, but more importantly, here's why we ended up at the value that we did, and here are some things that you might want to work on in order to get the price from here to here.
Yeah, no, that makes eminent sense. I mean, dressing a business for sale is not something that can be done in a month. It is a longer term process in order to get the highest multiple. So how do valuations fit into the larger strategy of wealth preservation and growth?
You mean in terms of value or?
Well, actually, let's change it up a little bit. Let's invert that. Can you share an example of a valuation or appraisal that had a significant impact on a client's wealth preservation or growth?
Well, that's a good question. I don't know if I've ever actually thought about it that way. I have had clients that will have started in the rare event that somebody actually starts the planning process early. We've been able to deliver a lot of additional value by getting involved in that process earlier, doing a valuation, letting them know what those value drivers are, and then going from there. We actually had one, it was more of a litigator role where we were able to help facilitate the sale of a kind of a unique business and nobody really knew what the value was, to really help get that from one party to the other, which was an interesting project in and of itself.
Yeah. What advice would you give young professionals interested in specializing in valuations and appraisal?
I would say one of the things that we struggle with getting people into valuation is just getting people to understand that the niche exists. A lot of times, we're an accounting firm. We get folks, that come out of accounting school and they say, "Are you going to go to audit or tax?"
Tax, yeah, right.
And a lot of the people that sit there and scratch their head and say, "Well, I don't really want either." Valuation is a good option. Somebody that maybe is a little bit more analytical. We do look for folks that are more finance and economic centric. So finance econ majors. Our complex securities group looks for mathematics majors, or even, people that have engineering backgrounds, because once you get good at moving the numbers around, which a lot of those, quant folks are, it's just a matter of learning the system. And so engineers are used to moving numbers around, and you just put a different set of rules around it. And so I would say, we're always looking to add more people to the industry. I think, like accounting in general, there aren't enough valuation people, and there aren't enough new folks coming into the industry. So we do work with a lot of our local universities to try to pull talent in. But it's exciting. I mean, it doesn't sound very exciting, but it's actually exciting. I mean, we see a lot of businesses. We learn a ton about how businesses work. We get to meet with a bunch of different business owners and really understand what drives value in businesses across a multitude of industries. And so we have a really unique perspective. Once you've been doing this for 5 or 10 years, you have a unique perspective that you can bring to a lot of clients because you've just seen a lot of business.
Yeah. So what's the most rewarding part of your work?
I would say the most rewarding part of my work is sitting down with business owners and really helping them kind of understand the why and the how that we arrived at the business, the number that we did. A lot of times people will say, "Okay, you're doing a valuation for gift tax purposes. I just need the number." But really sitting down with a business owner and saying, "Hey, here's why I got to the number that I got to." And FYI, to the point earlier, maybe they're not looking to sell today, but it's helpful to know some of those risk areas because we're trying to look at it like a buyer would. And the fact of the matter is, every business will have a change in ownership at some point, right? Whether it's wanted or unwanted, there will be a change in ownership. And so, really kind of understanding what that's worth and how it works, I think is valuable. And a lot of our clients really they don't get to do this on a regular basis. And so it's interesting for them to sit down with an appraiser and kind of understand what their business is worth.
Yeah. Are there any myths or misconceptions about valuations you'd like to dispel?
Yeah, I think that there are some myths around. A lot of times they'll say it's a very mechanical process, and it's very, it's a mechanical process. You just go in, you've got all the formulas, you just, you run the numbers through, and it spits out a value. And valuation is a lot more than that. Every business is unique. I've been doing this a long time. Every business, I like to say, is like a fingerprint. Each one is unique in its own way. And even when we're looking at a market approach, we really try to get in and understand the soul of each business. And so, I think the myth is it's very formulaic and it's very easy to, you guys just can you just come up with the value, running through this formula? And it's like, yeah, we can do that, but we're going to miss all of the intangible factors that make the business unique, which is what most business owners work so hard to strive.
Right. Yeah, the strategic value of this business. I get it. So how can listeners get in touch with you or learn more about your services?
They can find me. I'm on the Armanino website. I've got a page on the Armanino website. They can give me a call. My phone number is 314 831-310, or send me an email.
Yeah,
Jason.
I'll put your email on the post. Yeah, we'll make sure that's all covered. Well, Jason, super nice to sit down with you today and learn about your world, and look forward to collaborating with you on more clients.
Likewise, appreciate the opportunity to be here.